Hey YouTube, hi friends, welcome back to the channel. So guys, in today's video we'll talk about how mutual fund companies are actually fooling you and looting you without giving you the complete information upfront, and how you can save your money if you just understand this one thing and start investing wisely, based on the things which I will be sharing in this video. So a little bit of a background about me. I have a PhD in biochemical engineering followed by an MBA from ISB, and I am very fascinated by the world of investing, and I've been investing from about 6 to 7 years now. I started investing when I was in my PhD with my scholarship, worked for almost 5 years now, invested my money, manage a portfolio now, and in this video I will try to address the problem of mutual fund investing and what they don't tell you, right, and how you can then safeguard yourself, right. So first important thing you want to understand is that mutual funds are the most common financial products in the market, and it is in the interest of mutual fund companies to stick you the mutual fund, right, because if you are their customer, then they are making money from you in multiple ways, right. So first way is if you buy any mutual fund, there are two elements in it. So mutual fund charges something called as an expense ratio, and they put something called as an exit load, right. Now expense ratio is the money which is the percentage of your money which is invested, which mutual funds take from it to manage your money, right. And exit load is the penalty which they put on you if you withdraw your money within a year. So these are the two things which you have to keep in mind, right. This is what the cost of mutual fund is. Now if you continue to stay in the mutual fund for more than a year, you don't have to pay exit load, but expense ratio you have to pay. Now most private mutual funds, which are not index funds or passive funds, active funds, have an expense ratio of 1 to 2%, right. Or 0.6. Some these days are cheaper, they have 0.6, 0.5. But 1 to 2% means what? So if you're investing 1 lakh rupees into a mutual fund, they're charging you 1000 rupees out of this to manage your money, but you will not know that you are being charged. Why? Because when you buy a mutual fund, you get something called as an NAV of the mutual fund, which is the net asset value, which is the smallest unit which combines with all the units of the mutual fund makes the value of the mutual fund, right. So you get NAV units. Basically you buy NAV units with your investment. Now every day NAV is adjusted, and every day they deduct the expense ratio. So whatever NAV you're getting, it's already deducted with the expense ratio, right. So for example, and this deduction is so less that on a day-to-day basis you are not able to notice it. So for example, if you're giving 1000 rupees for a year, you divide it by 365 days. That is the deduction which is happening every day, and it is automatically adjusted in your NAV, right. Now what happens, most people think that the expense ratio is one-time fees. It's not a one-time fees, it's a every year deduction. So in the first year they will charge you 1000 rupees, and the second year, if let's say your mutual fund for example increases by 10 times, it becomes 10 lakh, then they will again charge 1% on this 10 lakh for the second year, right. So what is the 1% on 10 lakh? It is around 10,000 rupees, right. So they charge you 10,000 rupees for the second year, and this 10,000 rupees is not deducted on one single day in NAV. This is distributed by 365 and deducted every day from the value of your mutual fund. So this is how this deduction happens. Now you can see the cycle. So every year your mutual fund compounds, right, or it compounds maybe not every year, but 3 years there's a significant CAGR increase, right. Mutual funds maintain a CAGR, right. So 3-4 years there's an increase. So you just imagine if after 3-4 years your money is equivalent to 1 CR, just for example, then again that year 1% is deducted from this 1 CR. So every year you're giving more and more of expense ratio. Now this I think is a really bad thing what they're doing, and most people are not aware of it. And if you just evaluate it for a period of 10 years, 20 years, right, it is a very significant sum. So this you have to keep in mind, how to reduce this deduction if you can from your mutual fund investments. And how can you do this? There is a very easy way to do this. So whatever we learn in India, we learn from a developed economy called US. US has a very mature financial market. In fact, whatever we are doing in India is in some way or another is being an adoption from the US markets. And in US, there is a trend that most people over there are not investing these days in mutual funds or individual stocks. They invest in something called as ETFs, or exchange traded funds. Now, what is an ETF and how is it beneficial to you? So just like mutual funds, ETF is also derived from any mutual fund. So for example, if you have a mutual fund, just for example, I'll take Motilal Oswal Mid Cap 100 Fund, right? It invests in 100 mid cap companies. Now Motilal Oswal Mid Cap ETF is now replicating that mutual fund, right? But it is a tradable asset in the stock market, just like a share, right? So whatever is the increment or decrement happening in the mutual fund will be reflected in this ETF. And very important thing to note here is that since this is easily traded in the stock market, the expense ratio here, and it is passive. So mutual fund is active, this is kind of passive, right? It is just following that mutual fund. So here the expense ratio is 4 to 5 times less than the mutual fund. So if we'll just compare the expense ratio of ETFs, right, and the mutual fund, it is 4 to 5 times less expense ratio in ETF. And as a result of this, over time, when you wait for 10, 20, 30 years, the compounding of your wealth is gonna be humongous compared to the mutual fund, right? So ETFs make more sense. Now there are some people who try to be very intelligent, and I have also heard this before a lot, who say that ETFs do not have liquidity, and maybe some of you will comment in the comment section below that ETFs do not have liquidity. There can be a liquidity issue if you have 1, 2, 3, 4 CR. Now my counter to that is, if you are a retail investor like most of us are, we have portfolios of, let's say, maximum 200, 150 crores. So here, if you check the AUM, the assets under management, and the tradable volume of any mutual fund and the ETF course for that mutual fund, you'll see that mostly the tradable value, the volume which is traded in the stock market, is in the range of 10, 20, 30 CRs. Now what this means is that on one specific day, this much volume of that ETF is getting traded. So for retail investors, this liquidity issue is very, very, very rare. It is applicable maybe if you have more than 1000 crores of portfolio or above 100 crore, which is very rare for retail investors. So we don't have to worry about ETF. What we have to worry about is to buy the mutual funds cheap and invest cheaply to compound our wealth at a high rate over a longer duration of time, right? And that is why ETFs make much, much, much more sense when it comes to investing, for retail investors. Now, so having learned this, you have to keep this in mind, that I would personally prefer ETFs more than mutual funds, and I will try to go for cheaper mutual funds rather than expensive mutual funds, right? And whenever you're buying a mutual fund, always double check and ensure, even if you try to go with mutual funds, even after watching this video, you don't choose ETFs because mutual funds are much more easier and convenient to you to invest. Always buy direct mutual funds, right? So for example, mutual funds directly, which are direct, there's no distributor involved, because distributor then puts their own expense ratio over the expense ratio already charged mutual fund. So some mutual funds will see the expense ratio as high as 2.5%. This is humongous. This is just such a high tax on your wealth creation over time on your own money, which is your compounding in stock market. So keep this in mind, right, when making your investing decisions. All right, so I hope this video was helpful to you. If you liked it, do give it a thumbs up. Do subscribe to the channel if you're new here, And next video is going to be very important, guys, where I'll go deep dive into the what are the different types of ETF you can consider and which one you should consider to invest in, how to diversify, how to invest in foreign ETFs, how to invest in commodity ETFs, how do I do it, right? All those good stuff coming in this upcoming video. So don't forget to watch it. And yeah, I'll see you again. Thank you. Thanks for watching this video. Bye bye. Take care.